Great, thank you guys, and thanks to the Investor Subscriber Summit for putting on another very successful show this year in Toronto. And thanks to all you guys for coming out in this nice cold weather and making us Alberta boys feel very comfortable out here as well. So we'll start with the reader advisory and cautionary statements courtesy of our legal department. So let's start with the company. About 18 months ago, we had a strategy around capturing assets in Western Canada at very attractive financial metrics. We saw this opportunity primarily in companies that were financially distressed. So we recapitalized a company called Petroforte and began operations. Since then, we've been able to do numerous acquisitions at very accretive metrics to our shareholders, and with an ultimate strategy around capturing somewhere between 3,000 and 5,000 BOE a day of assets that we feel would be in one or two, maybe three core areas and attractive to a larger company for acquisition. So fortunately or unfortunately, our business model has been revived again here for 2015. So commodity prices that have declined materially, as we've all seen, are likely going to be the catalyst for deep value acquisitions. And hopefully this is where we'll be able to take advantage of some of those acquisitions to again build shareholder value. We will continue to exploit our low-risk development opportunities that we've created within the company, and we do have a top-tier technical and financial competence to enable us to execute on our business plan. So what have we done to date? We've done 5 accretive acquisitions and a farm-in. Most of those happened in the beginning part, late part of 13 and beginning part of 14. Prices got a little bit escalated, so we ended up going into more of a defensive role and moving more towards exploitation. And that's what created our 2014 exit production of about 1,400 BOE. 65% of that was oil and NGLs. Since inception, we've closed 3 different financings for a total gross proceeds of about $20 million. Obviously, debt is one of those things that in a challenging environment can destroy a lot of equity. So our mandate has been to do so all of our operations with a strong balance sheet, and we've got one of the lowest debt to equity ratios in our peer group. So having a strong balance sheet will maintain sustainability through this part of the cycle. We also entered a royalty arrangement to drill 6 wells in our flood property. This was strategic because it significantly increased our internal rate of returns. We're going to focus on consolidation in core areas and do so at attractive metrics. We do have a multi-year inventory of lowest drilling locations so we can move towards exploitation as acquisitions become more expensive. We do think that the recent share price decrease is a good opportunity for investors to get an entry point in, as we are hoping for an oil price increase at the tail end of this year. So obviously I can't control the commodity prices. The only thing management can do is navigate within them. So obviously I've got a long service background and controlling cost is something that I'm very good at and very used to. This is my 4th downturn, even though I do look quite young. I've been doing it my whole career. So the first thing we did is to align with shareholders is upper management took between 25% and 50% wage cuts voluntarily without the board asking us to do so. We wanted to align with shareholders and show people that we're aligned and moving forward with you guys. G&A cost reductions, we've seen about 25% on our G&A cost reductions. And the other big thing is reducing our operational costs at the field level, not just on a CapEx basis, as our CapEx will be materially less this year, but reducing our operating costs maximizes our margins from the field level. So now we're going to focus on strategic deals. We did a royalty funding arrangement with a company called Maple Leaf. This royalty funding arrangement was to enable us to maintain relatively flat production levels at a significantly increased rate of return. So most areas in the basin are completely, are uneconomic at current pricing. This brought our rate of returns from about 30% on a standalone basis at current prices to over 80%. And part of that reason is they fund the first 50% of the wellbore at the old prices. So we got a discount, obviously, from the service providers, so our contribution is only about $275 per well. So it turned out very much in our favor. We do want to remain optimistic, for other acquisitions. However, time is important. We have to wait this out. We just saw the decrease in commodity prices, so we have to wait this out. Deals will come, but they will start coming probably, second, third, and fourth quarter of this year. So we put in a minimal capital budget out for this year. We've got a $3 million capital budget. That's going to enable us to drill the 6 wells and some recompletions to maintain a flat production level for this year. Obviously, service costs are down. We're estimating about 20%. We might even see a little bit more just because the wells that we drill are traditionally lower technology. They're conventional wells, so that type of equipment is in a higher abundance. And we will move towards buying production if it makes more sense, obviously. So I'll talk quickly about some of the acquisitions so you get a flavor of the things that we've done. We've got a very strong M&A background and a bankruptcy restructuring background, so some of the deals we put together have been that way. So the first company was Expand Energy. We ended up buying Expand through a receivership process. We actually bought the debt from the bank. They had a $1.6 million debt at the bank. They had $8.5 million in trade payables. So everybody looked at the asset and said, $10 million, not worth $10 million. We agreed. We ended up paying net $700 because we bought the debt, ran it through receivership, and scrubbed out all those trade payables. So that got us a large Montney oil pool with 100% working interest in about 37 sections. Brass River, we actually acquired this property through just taking over the abandonment liabilities, and so we had actually no upfront cost in that 2 1/4 sections. We actually recompleted the wells instead of abandoning them and brought on over 400 BOE, so that was a great property, and it's got lots of multi-zone upside. In Wapiti, we did a farm in here, so we farmed in on a great property. We've been able to assemble a little bit of a land position now and some great wells, which I'll talk about shortly. We bought some additional property in flood and infrastructure for $1.2 million, which got us probably about $10 or $12 million worth of value. And then we bought a company called CAC Exploration, and CAC was a small company, a true value-based acquisition. We bought 330 BOE for about $6 million. By the end of 2014, we recouped all of our $6 million, and we still have about 330 BOE of production. So we did that through selling off some non-core assets and then doing some recompletions and cash flow. We've also just completed all the infrastructure in our flood property, which is the main property. This was absolutely imperative for us. Last year, our operational costs for flood would have been in the mid-20s. We were able to bring that down to $10 a barrel now with transportation of about $5. So even in current commodity price environments, we're able to make reasonable cash flows from that field. So things like that, if you're looking at investing in E&P companies, low operating costs are very, very important in this part of the environment. We have a management team that's very capable of running 3,000 to 5,000 BOE with very minimal additions, other than our wage rollbacks coming back in at some point in time. And we've had great results. Every hole that we've drilled so far, knock on wood, has been a success well. So we had 100% success last year. Won't spend too much time on this slide. We got about a 60-cent stock price, 42 million shares outstanding, very tightly held. We have about 15% on the management board. Obviously, a lot of friends and family and people that have invested with me throughout my career are involved in the stock, and Keith with his largest holding. So it equates to about a $25 million market cap. We've just renegotiated our bank lines again, so they are intact. We've just gone through the review process. So I can tell you our bank lines are not being cut. Our reserve report is about to come out late next week. I won't tell you what those are, but I can tell you that the reserves grew materially, and actually the values even grew materially on a much lower price tag. So the core areas we operate in, we've kind of got 3 main core areas. So obviously Northwest Alberta is our primary focus. It's where the majority of our production and operations are. We've got Central Alberta and Southern Alberta, which is the Brass River and Retlaw areas. What I'll highlight here is we operate and manage everything that's within our portfolio. So we get 75 to 100% working interest, and we decide where our capital goes. That's very important as well if you're investing in smaller E&P companies, because we're not getting cash called for things that we don't want to do. So let's talk about flood. We've got a proven ability to develop a play. And why I say that is we actually bought flood initially through the Expand acquisition. Then we completed 5 other acquisitions of companies and assets to create a nice continuous land base with all of the infrastructure, to run a successful play. So we put water disposal facilities in place, our gathering infrastructure, and now we've got low operating costs. So we've had 100% drilling success in 2014. So what does that set us up with? A total of 55 net sections. We actually just purchased another 5 at a land sale last week, so we're just over 60. And again, this play is unique because it's conventional in nature. Everything that guys are talking about now are the resource plays. So very high decline rates makes it very difficult to stack that production if you're not continually making that investment. So these low decline rates are very important. It is water floodable at a future date. We probably won't look to water flood it ourselves. Hopefully we delineate that play, and hopefully somebody comes in with a lower cost of capital to put the water flood in place. One of the big things that we do have as a benefit within the property is we've got a lot of horizontal upside. Kind of the medium green shaded areas where we're focusing today, but we've got a lot of horizontal upside, which unfortunately I can't talk about too much right now because I'm running out of time. The other two plays, I won't get into them too much detail. They're very prolific in terms of the land base. We've drilled 2 wells in Wapiti. The first one was 405 BOE, and the last one is 900 BOE per day just for the first 5-day test. That well's coming on here right away. Production growth, we've shown consistent production growth along with our production guidance is pretty much maintaining flat production for the year. And again, I guess as a company, we'll continue to focus on value-based acquisitions. We've done due diligence on over 100 companies at this point in time, and we'll continue to create value for shareholders in that respect. So, thanks. And it's CAC.